Brought to you by Standard Bank, the bank for entrepreneurs.
So within commercial property finance, there are two types of properties that are financed. They're either owner-occupied or investment properties. And the important thing to understand with owner-occupied properties, those are properties that people are buying to occupy for their own business and to trade from. And investment properties are where people are looking at capital growth and income-producing property. And why these two properties are important, or two types of properties are important, is because they have two very different ways that people look at them. And this is important when people come to the bank for finance. The driver behind an owner-occupied property is where the owner is looking at capping his cost, whereby buying a property he can limit what his rental escalation will be for the next 10 years or 15 years. He also secures tenure, which means that he can trade from a property for a length of time. He's not at risk of losing where he trades from to a competition or to any other person from that, for that matter. Why that is key is when they are preparing their cash flows, that the clients look at putting the full picture to the bank, that they unpack exactly what is involved in the property, what the rental rates are, what the impacts on their cash flow of their business is, because if they buy a property, it does have an impact. As much as they are paying a rent currently, as a landlord you have other obligations that come with it. And often they look at the upside only, and they don't take into account that you have a number of factors that come into play. Things like working on the property, renovations, refurbishments, if a tenant had to leave, that type of thing. Additional power sources, putting in generators. When you're a tenant, you don't have those worries. Those are borne by your landlord. What we look for in the bank is that the person has looked at every angle. When they've done their cash flows, they've looked at what the impact into their business is, what the upside is, but also what the potential downside is. What is also key is if you're looking at investment properties, that the same rigor is used, that people look at the properties and understand the area that they are looking to invest in, that they understand the dynamics of the area, what is coming up in the area, what could be a benefit and what could detract from the property and from the investment, because this is a long-term investment. Property is that. And for us, is very key is to understand that it isn't putting cash flow strain on the person's other incomes. So we aren't looking at people having to subsidize out of their trading company or out of their personal income to make a property investment work. Property investment work must work on the basis that it stands on from that basis.
Brought to you by Standard Bank, the bank for entrepreneurs. Standard Bank. Moving forward.